Hey Jake, can you hear me?
What's up, Steve? How are you?
Good, how are you?
Great, I'm great.
It was a good call to give me the extra 15 minutes. I needed it.
Yeah, you're good, man, of course. Yeah, we'll give it till 6:40. Let
Okay,
people trickle in, and then you'll be good to go.
sure.
So Jake, I don't know if you saw the thing from the realtor in St. Louis. You've got to wait 45 days to sell the property.
Why?
Some stupid state law. It's crazy.
45 days?
45 days. Yeah. I'm ticked.
Okay,
Yeah.
that makes no sense, but sure.
Yeah, I know. It's crazy. It's so I guess to allow anyone with mechanics lien to, I guess, claim something. I don't know. Very disappointing. Amy's going to give us a quote to see what it costs to paint the front of the house or the house if we want to do that, but
Well,
or save that in our back pocket. If it
yeah.
doesn't sell.
So the 45-day period starts whenever we're fully completed with renovations.
No, and that's the other thing that ticks me off. We could have submitted the day after we closed, but I just learned this today.
Do you submit it today though?
What's that?
Did you submit like the start of the 45-day today?
Yeah, because I got to get the letter notarized. So I got to do it tomorrow.
Oh,
Yeah. So 45 from tomorrow is the soonest we can close. Unbelievable.
It's like it's so annoying. It's like funny.
Yeah. Yeah.
So Jackie, how are you?
Hello, guys. Thank you for doing this.
Yeah, of course, no problem.
Yeah, I learned so much on these Zooms.
Awesome.
So today is going to be number 3 or number 4?
Number three.
Today.
Number three.
Okay, number 3. Okay. Yeah, I got confused.
Yeah, we skipped last week for Memorial Day.
Oh, yes, got you.
Okay, I lose.
What's up, Tigger?
Broke my silence. Why were we radio silent? It was so quiet.
Wow. Yeah. Waiting to get people on.
Yeah, we normally have like 10 to 15, but we're looking a little low today, but that's right.
Screwed up their time, didn't you? I think
It's all right. It's all right. It's 30 minutes.
Pace has a call, our Zoom going on right now. What's happening, Steve?
Hey, it's okay.
We're gonna have Abraham Heiser on Thursday's call.
Remind me who that is?
He is a coach, a speaker, kind of like a Tony Robbins, and he works for Dean Graziosi.
Ah.
He does coaching and speaking events, sales. He's in our Deal Connectors group, and I asked him to join us for our Zoom. He's also gonna have, I've spoken to Eddie Charger a few times, but Eddie Charger also does private money lending, and he manages a fund of funds. So he's asking also Eddie if he'd like to do a Thursday Zoom for us.
All right, Steve. I think it's showtime, man.
All right, go.
Yeah, let's do it. But can I give a brief introduction of how you got started, and then from there take the show away, my man?
Sure, sure. So for those of you that don't know, my name is Steve Velez. I joined Sub2, I believe, early last August. So about 10 months in, like I came in as someone who had already had multifamily experience, but really just looking to understand better creative financing techniques to apply to multifamily. So I've been doing multifamily for about 5-ish years. And so I have quite a few GPLP and JV positions across several states. And so in that course, I kind of learned that like underwriting was one of my superpowers. So I kind of stuck with that and used that as building up my strengths, but also gave me an opportunity to kind of pick up other pieces of the the skill set puzzle that I think we're always searching to do. I was planning on kind of walking through, how to look at multifamily underwriting. And so one of my goals in this session was to keep this as interactive as possible. But also, I have a lot of these sessions with quite a few people just kind of walking through underwriting. And I typically get the sense that people are in different places very often. So one of my main goals is just start from ground zero. I've heard things like people have been in different sessions with different people and they get very high level and it gets very difficult to keep up. So my main goal and expectation setting here is that like I could not possibly give everyone from A to Z of underwriting today, but my main goal is to start from a basic place, and I will elevate or modify as I feel like people are asking questions and curious about what we're talking about. So if I am going too fast, ask a question, I'll slow down and take a step back, because I think multifamily is one of those things where when you underwrite it, you have to get the basics and you have to understand the concepts before you go any further. I'm also aware of the fact, being that I'm also a PML, that you don't have to know how to underwrite like a master underwriter, right? You kind of just have to know what deal is garbage and what deal might be a deal, right? And then, potentially if you're a great underwriter, great. But if you know someone who can underwrite the details, it's probably better to find someone to do that, because there's a lot of different levers that we'll cover at a basic level today, but my intention here is not to make everyone like a master underwriter. I think I could certainly help do that over several sessions, but I just want to start at the basics here. So there's any starting questions or, or any potential highlights I can take note of, to make sure I comment on, I'd love to take some now.
I do. If I do, how long are we going to take this session for? Like
I was
60
planning
minutes, 90,
until, yeah, I was planning until about 7:30.
7:30. So it's going to be like 60 minutes. All
45
right. In
minutes.
case, yes, we do. I mean, we're not going to, get all the questions answered, but is going to be any chance that we can get in touch with you later on, or we're going to have a part 2? Because I
Yeah,
know
we could,
multifamily, it's a lot.
yeah, we can have as many parts as we need, Jake. So definitely feel free. But you can also scan my barcode, right? And you'll get access to my Calendly
Yeah,
and
I got
contact
it.
information. Yeah. So, but offline we can also connect. So if you have specific questions,
Okay.
more than happy to help.
All right. Perfect.
Yeah.
Thank you.
All right.
If I would say, to kind of get us started, when underwriting multifamily deal, what is like the first like needed information when sent a deal? Like what's the needed information that you need?
Yeah. So I would say that it starts with having financials. So typically I would need, I'll get super basic, right? I'll need an address. I'll need to know what the NOI is. And that NOI could be, tell me what your income and your OpEx is, or just tell me what your NOI is. And at that point, I can probably start to figure out at a high level whether or not I think it's a deal or not. Those things can be found in an OM. Those things are typically found in a T12. A rent roll is really important. So if I start to go one level higher, I want an OM, I want a T12, and I want a rent roll. A T12 is basically a profit and loss statement for the last 12 months. So you'll hear things like T12, that's the trailing 12 months. You hear T6 is the trailing 6 months, or T3 is the trailing 3 months. Those are kind of the three main documents, I would say you start with.
Now, I've seen those documents can often just be an Excel spreadsheet. Is that a red flag, or should there be more professional looking thing, or is just that normal?
It's a great question. That's really a preference, right? So the cleaner the books, the easier it is for you to underwrite.
Hmm.
The dirtier the books, the longer it takes you, the more advantage you have, right? Like we all say, the more work you take, the more risk you take, typically there's better returns. So if you find someone who's got like a bunch of stuff on a bunch of napkins, and you get friendly with the seller and you can sit there and work through auditing their books, like you can kind of make the case that, nobody else is going to go through this and this is my price. So, it kind of depends how much work you really want to put in. But I would say if you got a good set of financials, that's a very good start, right? Because
Okay,
you're not trying to
so
find the data.
So a spreadsheet rent roll is normal then.
Yes.
Okay.
Yes.
Gotcha.
Or a PDF version of a spreadsheet, right? But yeah. Yes.
Okay.
Typically it's a Excel T12 to Excel rent roll or a PDF version of that.
Gotcha.
Yeah. I didn't say OM in the beginning, mainly because OM, for all intents and purposes, to be quite honest, here's what I use it for, right? I use it to give me the address and typically they have a quick snapshot of like what the unit mix is. It's a 2-bedroom, there's 22 bedrooms, 21 bedroom, a studio, and 5 3-bedrooms. Here's the square footage. I like that because that tells me unit mix. Other than that, for all intents and purposes, I don't believe anything in an OM. So I would just kind of use that with a grain of salt. I try to get facts out of the OM, right? Good to know the market. They'll do a lot of material on what the market looks like and how many jobs are there. And those are all really good things to read material wise, and you should validate anything you see in an OM. But do not believe a pro forma, do not believe a cap rate, like do not believe any of those things necessarily, unless you're getting it from a trusted source. Like if you're really good with a broker and they give you good positive feedback and you trust it, then that's good. But it's all about your own knowledge or resources that have that knowledge. Yeah. All right, so let me start really quick. Jake had sort of prepared or provided like a sample deal to work on. So I'm gonna say, let's start with that. So it's funny when Jake and I spoke, I said, look, I'm gonna start with a blank spreadsheet, right? Because I don't want people to get stuck in the model, and I'm probably not even going to touch a valid model in this session. I'm going to try. Let's see if we have time. But the reason why is because to learn an underwriting model is a lot of work, right? And it takes time and it takes practice and it takes understanding the equations and the formulas, all that stuff. And I don't want to dilute the intent of just getting you guys to understand what's the important things in underwriting. So I would say don't even read this, right? Like I'm not even planning on like providing this unless there's really an interest, but I didn't want to start typing this stuff and waste time typing. I wanted to really start to answer questions and provide value. So we'll go through this very basic. So yeah, don't pay too much attention to the model or the formulas that are in here. So what I have here is side by side. This is a oops, do this. See it better. First, can everybody see my screen okay? Is it too big, too small?
Yep.
Yeah, okay. So
Zoom in
here-
the spreadsheet just a little bit.
Yep. How's
Thank
that?
you.
Okay.
Perfect.
So here's again, if you look at this OM, literally the front page, I already got what I wanted, right? I know the name of it, I got the address, it's 128 units, I got the age, right? For me, I like certain age or vintage of buildings. So like for me, I typically look at 1975 or newer. Unless there's something juicy in here, I probably would, it's a big red flag for me, meaning it's just not part of my buy box. Doesn't mean it's a bad deal. Just looking through the OM, you'll see things like, they happen to have an assumable loan. So we'll talk about that a little bit. In multifamily, a sub 2 isn't as frequent, but loan assumptions are. And the difference between a loan assumption in a single family versus a multifamily kind of have a different outcome. So I'd say if you come from a single family world, loan assumptions are pretty common in multifamily. And in today's world, they're actually searched for. So it just depends on your particular strategy. And then here's where they start to talk about the market. Let's make this bigger just so you can see. They're just talking about the market. It's just marketing material. Now they're talking about the property. And here's what I was talking about, right? Now they tell me they have 50% one bedrooms, 50% two bedrooms. It's 128 units. Here's the acreage, average size. I like to look for this metering. This is important because you want to know what are you paying for versus what the tenant is paying for. So in this case, you see the electricity is paid by the residents, but the property owner pays gas, water, sewer, and trash. So then you can start talking about, well, how do you recover those costs, right? Because the more people using water, the more your OpEx goes up. So unless you really charge back the tenant for it, there's no motivation to kind of manage the expense on that. And then amenities, right? So here we go. Oh, one bedroom, one bath, 860, two bedroom, two bath, 1,000. I have what I need, right? We have 128 units. We have 64 one bedrooms, 64 two baths, and here's the unit. That's pretty much all I'll pay attention to here. You'll notice I'll have like things like a pro forma, an investment summary. Again, I don't pay much attention to it because it's their underwriting, it's their understanding of the investment summary. Here's the table I was talking about. It's like a one place to go for what their size is, unit count, and what their market rent is versus what they're getting now. Again, this I would validate with a rent roll, but it gets me started, right? It gets me started on the back of the napkin kind of thing. Here's some rent roll analysis. Here's like a kind of a trailing 12 that they took and just put into PDF form and they grabbed it off the use. Sometimes it's pretty nice, kind of tells you what to find, but for back of the napkin, this is too much, right? For now.
Steve,
Right?
T3 and T6s, why would somebody want those, not the T12?
So nobody, I would say you always want the T12. You don't really want a T3. T3 is too short because 3 months, for example, in 3 months, when did you pay taxes? Right? If you pay taxes in February, it doesn't show up on your T3, right? But I would say if people can show a T12, when you get to another level of underwriting, what you start to do is you may start to say, let me annualize their T3 income against my annualized OpEx, meaning how much do I think it will cost to operate the building for 12 months, and let me annualize the T3. Why is that important? Because you're going to control your expenses when you operate. So you want to have a sense of if they were operating the property very cheap or overpaying, you're going to be the one that manages that much better. So you want to assume your operational expense and probably use their T3, their T6, because they might have been doing something to produce more revenue. Right. So, but if you get a T3, that's usually not enough to hold some underwriting, and banks will do what I just said. They'll use a T3 income with your with your pro forma OpEx, but they'll typically want to see a bit more on the analysis. All right. Other than this, they just tell you like what they did on the operating statement, what they, how they assessed their pro forma, how they got to the 10-year cash flow. Again, it's just them explaining to you why they think this is a magnificent product and you should buy it, and they think it's going to make a whole bunch of money at some point in time, right? So let me snap off of this for a sec.
So
and
that
go back.
pitch decks are basically a lot of fluff.
Yeah. I mean, like I said, every broker has their own kind of way of dealing with this, but yeah, I would say you take the very tangible facts out of this, and I wouldn't worry about all the details. It's good to read. You'll learn more about the market and what they're selling, but it should go into your underwriting for the most part. Jake, do you remember what the asking price for this was? Off the top of your head.
13, Steve.
Oh, 13. Oh, Alex, hey, welcome. Thank you.
I got you.
Okay. All right, so here's where I'll start, right? Here's the back of the napkin, okay? So again, don't pay attention to the spreadsheet. We're just gonna talk through what this looks like. Purchase price is gonna be 13 million. Okay. If I pull up their T12, it's coming. Okay. If I pull up their T12, what I'll see here. So just for illustration purposes, this is a T12, right? They go from April to March, 12 months, shows all their income, all their expenses. Okay, it's rather long. Again, for detailed underwriting, we would do deep analysis of this. For back of the napkin, we're not going to pay much attention for now, right? So let's see what our total income is here. That would be this line, total operating income. Right, we got about just under 1.7. Okay, and then I'm going to take their OpEx. Now, another reason why you don't use the OM is because over time, what happens is investors, if this has been on the market for some time, they'll ask for updated T12s, but they won't necessarily update the OM. So you might have an OM that's going to show you information from January of 23 to December of 23. You want the most accurate information possible, right? And so this was actually April to March, which is pretty decent. So that's another reason why I don't bother. They have a T12. I doubt it's older than the OM. It's probably the same or better, right? So here's the total operating expense.
Steve, would you use quarterly information? Like, let's say somebody sent in a year, January to December of last year, but then they only sent like January, February of this year. Do you need like a quarter to show, I guess, maybe if they do taxes for that quarter?
I think a trailing 12 is still fine. If you want to use the last 9 months of last year and the first 3 months of this year, it's still 12 months. Yeah. And so I'm just going to plot OpEx here. And so what am I doing here? Basic math here, right? Gross income minus operating expenses, my NOI. That's it. Right. And it should match here. See, actually, this is it. This is their NOI. Okay. Because I'm not going to decipher how accurate their income is, where they fudge the numbers, where they're looking at OpEx. I'm not looking at that right now, right? I'm just saying this. And so if you look here, you're saying that the ratio, the OpEx ratio is about 46%, which means the way they're operating now, they're spending about 46%, almost 47% of their income on operating expense. Okay. If I'm doing a back of the napkin, I typically, if I don't have any OpEx and someone just gives me gross income, I typically use 45 or 50% OpEx. But when I operate, I want to be below that. Right. So I assume very conservative, but when I actually operate, I target trying to get closer to like 40, percent, depending on the asset itself. We won't bother with CapEx for now. We don't know. Let's just pretend there's no needed work to be done, right? And so the difference between CapEx and OpEx is OpEx is operating expense, meaning what it takes to keep the building running and running well. CapEx is capital expenditures, meaning extra cost on top of, or capital improvements on the property. New roof, new HVACs, adding a dog park, any of those types of things is going to be CapEx. Right? Typically with a value add is. So when someone's going in and rehabbing units, they say, oh, we need to spend $10,000 per unit to get them to hit market rents. Your capital expenditure is going to be covering the rehab. So let's just pretend there's no CapEx here, right? Closing costs, we'll assume, let's just say it's about 4%, right? Just for this exercise. And typically today, if you're going to go conventional lending, typically today, most banks, especially agency, will expect you to hit, a 70% LTV, which means a 30% down payment. Okay. So now what are we saying here? We're saying our capital invested here is 4.4 million. What that means is we didn't put any CapEx. We have about 4% closing costs, 3.9 down payment, and there's about $4.4 million in capital invested. Now, there's other fees. There's other things that's going to make this number go higher. You're going to charge syndication fees. You might have an assignment fee. Your bank's going to ask you for having capital on deck, right? Just in case something goes wrong. They then may ask you to hold 6 months of insurance and 6 months of taxes for reserve. So there's more money here. But the point of this is this deal trash or is it something to look into? That's the first goal, right? So just don't go too deep until you know how to read this quicker and say, I know it's worth doing more underwriting. Okay. So this just means basic math, right? I just took the loan amount, I subtracted the down payment, I got a $9.1 million loan. Let's assume that today it's about a 7% rate. Again, you may know a lender that could do better or worse than this. And that means that this formula is already in here. This is actually amortizing a 30-year amortize of 7%. The annual debt service is going to cost $726,000. Okay, so that means that if I take my NOI, which is how much money I made after I took out my expenses, and I pay for my debt service, I will be left with $175,000 in cash flow. This is really important. I will tell you that 80% or 75% of the deals that I get to underwrite or help people underwrite, this is a negative number. That means that you can't even pay for the mortgage. Okay. So this is why this is going to help you easily weed out the trash. If you just do this basic math, purchase price, gets your NOI, figure out how much your loan payments are, what rate, and just figure out, can you afford a loan? If you cannot, it is garbage. Okay. Now, if you know something about the property, maybe it's worth it, but just on a piece of paper, it's just not going to be worth your time. You'll see here something called the DSCR. DSCR, for those that don't know, is debt service coverage ratio, which is 1.24 basically means is we can cover the debt service and we'll still have about 24% of our NOI left, which is good, right? Most banks will look for 1.2, 1.25, 1.3. So just looking at this is pretty close to being able to get a conventional loan. Okay. Cash on cash, this is important. Okay. What's the difference between NOI, cash flow, and cash on cash? NOI is just your bottom line profit and loss, right? Income minus expenses. Cash flow is how much you have left after debt service. Cash on cash is how does that compare against the money that I invested? What's my ROI? Okay. So if we look at these numbers, let's just go back. We're going to backpedal a little bit. Here's my NOI. If I take my NOI and compare it to my purchase price, that's what this number is telling me to do, right? This means if I bought this property cash, I bought $13 million to the table, I'm going to make about 6.9% return. right? Because I have no debt service. I'm not doing anything else. I'm just buying the property cash and moving forward. Again, there's closing costs. There's all these other things we can talk about. If I look here at cash flow, I told you I'll have this much more once we get over the debt service. This is saying that because I'm investing $4.4 million to purchase the property between the down payment, the closing costs, etc., I'm going to be left with about 4%. Why is this important? Do you know anybody that's going to help you raise $4.4 million to get back 4%? Probably not, right? Do you know anybody who's going to bring cash to the table for 7%? Right? There are people who want to park their money and get tax benefits, sure, but not the people who are trying to get return. So these are why this basic underwriting, how does my NOI compare if I buy cash? How does my cash on cash compare to my debt service? Really show me whether or not this is going to be worth it. Now, in my opinion, as long as you're near 3-ish, it's worth going to a deeper underwrite. Right? Because it means we haven't done anything yet. We haven't pulled and pushed any levers. We haven't figured out, can I get a better loan? We haven't figured out, can I actually reduce the water leak that I can tell is happening when I look at the P&L, right? We haven't done anything yet, right? We haven't even figured out how much are we going to improve on rents. So once the goal here, it's not trash. This is not trash to me, just off the bat, right? This is worth going a little bit deeper and deeper and deeper, but you start at this level. And then I just want to wrap up sort of these basic deals. We talk about cap rate. Now, a cap rate, you'll see here, this 6.9, people talk as an asset cap rate. And that means what I said earlier. What's my return if I bought it cash? There's no consideration of debt when you talk about a property cap rate. When you look at a lot of OMs, they'll talk about a cap rate. And that's usually this number, usually. But the market cap rate is what are multifamily assets in that market typically trading for? So if they came back and they said, well, that market cap rate is really a 7.5%. And this means you know the market really well, you know a broker, you know a property manager, someone that or yourself that has insight on that market. You can kind of deduce that the valuation of this property is going to be $12 million. Now, how do we get that? Because the way we evaluate multifamily versus single family is very different, right? We don't look at comps of the assets. We look at what have other sales done in the market. If you take the last 6 months of sales, the last 3 months of sales, and you took their NOI and divided it by their sales price, what was the cap rate? And they look at an average. And it makes a difference because what happens is someone's going to tell you, well, this cap rate's 5%. It's not 7.5%. And you might listen to the broker, you might listen to the OM, and look what it does to the price. Right? It just jumped from 12 million to 18 million. And this is a lot of times when I know deals don't work. This deal that I would have seen any other time would have come to me with an $18 million price tag. Right? And it's in a 7.5 market cap rate, which I know. And I'm like, you're so overpriced. And look, my cash flow is negative. Just like I said, right? This is very typical what I see. The multifamily sellers are selling with the idea that the mortgage rates, the commercial rates are where they were before, and or the market cap rates were where they were before, because there were markers that were trading at 3-4%. That's very steep. I mean, if I just pretend here again, I go here now, a 3% market cap rate, all of a sudden is a $30 million property. So you have to be very careful when you read the OM to understand what is the market cap rate, not what the OM says, not what an untrusted source says. I think when I looked this up, this market was probably more of a 7.5 cap rate. So I thought that this price was relatively reasonable. Okay. I said a lot, but I wanted to go through these fields. So let me take a pause and see if there's any questions on the fields I mentioned and the relationships.
I have a question on the market rate and the area. How are you looking at that? So you're relying on the broker to help you with the market rates?
Yes, or sometimes property managers may know, or someone that's in the market knows, but there's some tools out there like CoStar has some of this data. CoStar is like a multifamily version of PropStream. They're primarily focused on commercial real estate. Reonomy might have some of this too. They're again also predominantly focused on, they do both, but they have a good usage in multifamily. So this is sort of knowledge based, right? Based on what's trading in the market today. Okay, and the reason why this is very different to like, again, single family is, again, there's 10 houses in your block and they all have the similar comps. They've all been selling at a certain price. It's very likely that's how they'll comp your property. But in multifamily world, you can't do that because each house might have a completely different NOI, right? One that's operating very clean is going to have a higher value. So for example, if I were to say that my operating expense was really $50,000. Oops. $500,000, all of a sudden the valuation goes up, right? Why? Because my business of a multifamily asset is showing that I'm having more net operating income, and therefore it should be valued more than Jake's, who is only operating at 90 something thousand, $900 something thousand NOI. So this is what motivates multifamily operators to increase their NOI so that they can get a better valuation or refi and get their money out, etc. Okay. Any other questions? Okay. So a couple things I wanted to call out here too. Your down payment's going to make a difference. So if suddenly you decide that you wanted this to be a 40% down payment, you're going to see your cash on cash change, right? It's gonna go up slightly, but you also have to raise more money. It's going to go up because your interest rate, is high-ish, right? It's higher than if you bought this cash at 6.9%. And this is why multifamily is suffering now, right? Because if you can't buy it cash,
Yeah, I was just getting ready to ask
Right.
about that because is it an adjustable rate that they're getting and now they're getting ready to check in or cash in, I should say, the banks are getting ready to cash in on these properties because they went so low rate and now they're done and they're
it's not so much that they were a variable. There's some that was doing that. It's that they had a certain term and the term is ending, because in multifamily, you typically get like a 5, 7, or 10-year term. So if you've gone through your 5-year cycle thinking you were going to, value add and refi out, and now the rates are higher, people are less motivated to get out of the debt, right? And so, but they're forced to. They're forced to. Right, but the real reality here, like I said, is if you could buy it cash at 7%, why would you go to a bank to get it pay 7%? This arbitrage is not far enough. Right. And we didn't talk about stabilization. So, we can cover that. But if this was really 6.5, now you're starting to get to a place where now it's like almost close to 5. Right. If I was to kind of jump over to stabilization for a second, say, well, what if we increased rents and reduce operating expenses? Then you will see that it will make more sense, right? Because you'll see the valuation will go up. But before I do that, I want to make sure that this is understood, right? It's not about how we model it. It's about what do these mean? How do they relate to each other? And how do they influence what makes this a good deal or a bad deal? Any other questions? We didn't talk about creative, right? So obviously there's ways if you were able to justify this as a creative deal and you got something at 3%, right? And let the seller finance this whole deal to you. I mean, look, you're making 10%. Right. So this kind of goes back to the art of creative. What I did want to do real quick, before we go over to stabilization a little bit, is this was a loan assumption, right? So let's just pretend we took these terms here, right? They had about $7.2 million of debt. So let's see here. They have 4.96. 30 years, that's 7.5. So that means that you would need to raise about $6 million to do this. It's roughly, yeah, 13. Yeah, that's about what it would take. If we were to assume this loan, you probably would have a smaller closing cost. If we were to assume this loan, it does make it better. Right? This is sort of the equivalent of like, I don't want to say it's equivalent to the subject to, but here by assuming this loan, we have to bring more money to the table. You're raising more money, but you're offering a better cash on cash return. And again, we did not even talk about stabilization, right? We didn't talk about adding income and reducing expenses. So this wouldn't be a bad deal if you assumed the loan. One consideration I would take, and this is Tigger, to your question, look at this maturity date. This was a 10-year term, really long. They actually got this before the rates were extremely low, right? So they got this at a good time, but not the best time. But this is going to end in 4 years. So if you think that it's going to take you like 3 years to stabilize this, you're cutting it a little close, right? Then you will be in a position where you have to get out. And if you're just trying to turn this, then you're at risk. If you're trying to hold this, not bad, right? You can decide that you get into a new loan, you've already added all this value, it's okay. This is not a bad play. This is a smart person who got into really good long-term debt, but his clock is running out.
So with multifamily loans or interest rates, I know you said they're different, obviously, than a single family. So are they more, or are they just market rate at the time?
That's a good question. Typically, and let me do this. I wanted to show you guys this as well, because this is, I failed to mention this. Of all these we went through probably 2 levels here, but back at level 1 or level 0 was some basic information I typically look up. One is going to be, just so you know, what's the 10-year treasury trading at today? You can probably guesstimate that you're probably about 200 basis points over this, maybe 250. So one could argue you could probably get somewhere between a 6.4 to 7.2 debt on this. Again, depends if it's agency or community. But I would say probably 250 basis points over the 10-year treasury is a good place to kind of starting point for a rate. Changes out all the time, right? You can even see here, this is the graph of like the last year. Look at how volatile it is. Much better here. You get close to 5 something in December of 23. Much worse here, right? You're talking about 6.7, 7.2, right? Once you add the commercial rates on it.
I did
Right.
just recently see something as well, like multifamily is offering a low rate now. Is it because of all these terms that are ending and the market is going to be like saturated with all these crazy higher interest rate?
I don't think it's related to that. I think it's more related to the fact that it's a bit more stable against the treasury, and banks understand that it's more about operations than it is about comps. Right? Like you can drop home prices because people are buying less homes now because the rates are so high, right? But if you're operating at a really good NOI, let's just pretend you got this property to a really good NOI. Let's say you got it to like 1.7 million. If you had to refi out into a 7.5 rate, even though you had a 4.5 rate, yeah, that sucks. But you're probably still gonna sell at 18 million, 22 million. And you're still going to be able to pay back your investors and still make money. I mean, you could be greedy and you could say, no, I don't want to do it because I want to get this number, or you can just take what the market's going to give at the time, right? So, and I think if they sell, then the rates will always kind of, the cap rate will always move towards that, but because it's more tightly binded to the 10-year treasury, it's more based on what that will show, right? If you think about it, if you're going to invest in a treasury at 4.5%, and you're going to borrow 250 basis points over that, it's not that much of a spread once you look at a NOI. The two things I want to also add as far as the basic part of this is what's the median income? Again, this is a little bit of this is about buy box. But if I take this address and I go to this website, which I will also share the chat. Okay. This is using census data. And what this tells me is, what is the median income for this family, for this tract? This is a census tract. See these blue lines? $88,000, right? I typically like to aim for above 40, 45 on my floor. But if you look, you can also click on this little box that says user select tract. And I can start to like navigate on the other tracks here, right? And say, like, what's a neighboring track look like? Oh, 105. More income. 98. 75, a little bit lower. So above this line seems to be higher income and they're on the border. Below this line, 65, 112. So the western part is okay. What if I go further north? 125, 122, right? So I'm getting a sense that above this line is generally 90s, 80s, and above. Some of these parts here on the southern or east are a little bit lower, and the ones in the west are a bit better. Why that's important to me? That might tell me something about the path of progress, right? Are those neighborhoods changing in that direction? Right. This is where knowledge of the market is really important. Or is it leaving that neighborhood behind? Is it gentrifying outside and sort of leaving it behind? Right. So, but again, all these numbers match would meet my buy box. But this is important depending on the type of housing you want and the type of clientele you want.
So is this open for single family use too? Like I'm thinking, why aren't we using something like that for single family comps or areas? You know how they always say you're comping, you're not to cross over a major highway or.
Yeah, sure, sure. But for me, like what I do is the general rule is that you want people's rental qualification should be no more than a third of their income. So you can use this number to say, okay, well, if my rent that I'm getting now is already about 33% of the estimated median income, that tells you may not be able to get rents higher. Again, if you know that market is in the path of progress and it's going to start to grow into one of these that are, $40,000 higher income, you're fine, right? But that tells you where if you are 20% of the median income, you have some room to grow. It means people might have some capacity. If your asset warrants higher rents, they have the capacity to pay for it based on their income. Right. So sometimes this can be a red flag if your current rents are already nearing that 33%. The other thing I like to do is I take the county and I go to a website called Fred. Not sure if you guys have ever seen this before. Actually, let me put this in the chat. This has so much financial data, financial analytics data, economic data. I like to go in here and I'll just say resident population, Wayne County. And by the way, there are tons of reports in here, right? So you can go down a lot of rabbit holes, but I like to look at resident population because I want to see populations growing. And look, this tells me a lot, right? It tells me it's been declining for the last, 50 years. Again, this takes some market expertise, but if I just look over the last 8 years, COVID, and doesn't seem to really recover from COVID. I'm not sure if it was because of COVID, but this is just telling me like it's never really recovered. It's at 1.78 million. It's at 1.75 and seemingly declining over time. These two things is usually something I look at first, right? Is the median income something I'm pleased with, and is the population something I'm comfortable with, right? And then there's sort of going through the process of, can I afford the debt? So do I like the resident population growth? Do I like the income growth? By the way, I didn't show you this before, but you can look back a couple of years, right? So if you go back to 2022, it was at 83. If I go back to 2021, it was at 85. So it does, it's moving, but it seems to stay in a similar place. That tells me it's not really growing, but it's not dropping that significantly either. So what's my income? What's my resident population? And honestly, can I even afford the debt? And that's what we started with, right? Can I afford the debt? Fourth is, can I even get good returns that I think investors will be happy with? Okay, so any questions? That's all current state underwriting. We have not even looked at how to stabilize the property.
What would a typical return would be an investor looking at multifamily be?
I think most investors would want a cash on cash off at least 6, probably 7. So 7 to 10. I mean 7 to 12, but 7 to 10 is probably more common. They would probably want an IRR of 17 to 25, 17, 22, IR being sort of an annualized time adjusted return over the whole period. So people typically say over 5 years, you want to try to get to double your money. That would mean that you're probably getting close to 20, 25% per year over the next 5 years.
And you would be getting more money based on raising rents.
Yeah. So let me cover that for a few minutes and we can kind of leave this to segue into the next one. But let's just pretend for a second that you knew you were able to increase the income by 35%. Okay. Again, you probably would have done this with some CapEx, but now we're talking, this is a few years later, right? This is 3 years from now. Let's just say that you were able to reduce your expenses down to 35%, right? And let's just say you were right about the cap rate. I mean, now you're talking about a $19 million valuation. So between your purchase and your stabilization, you've doubled your cash on cash. You've increased your valuation, not because the market has traded any better, right? The market's still trading at 7.5%. It's because your NOI went up $500,000, $600,000. Why? Because you increased rent, you added a dog park, you did some rehab, and again, let's be honest here, we did rehab. Let's just say we added $12,000 per unit. 28. Oops.
Regular. That would be regular.
Okay. Yeah, we're still doing really well, right? We're still getting 12.8% return in the third year of stabilization, right? This is where the deeper underwriting is going to get you to start looking at rental comps, improving operating expenses, changing your insurance, charging back for utilities, adding more value so that you can get to a place where you can say, this is where I'm starting and this is where I'm going to end up in 3 years. My investors can have some faith that we'll be in a good place. If I sell, right? And if you reverse engineer this price into another 70% LTV loan, you're going to get back 13.86 million. How much did we invest? We only invested 8.3 million. So this is where the value add comes in, is that you want to focus on, is this enough for me to entice investors to understand that even if I don't make anything the first year, okay, this is why I said I'm fine if this is 2%, 1%. I'm totally okay with that. If I can get stabilization to show that we're going to be producing good revenue and good NOI, so I can get this valuation to get to a good place, the investors will be happy, right? They will be absolutely happy. So don't think that on day one, you have to return 7%, right? This is not very likely, right? This is okay if it's 2%, 1%, 3%. But when you do detailed underwriting, which we could do in the next session, you'll start to see that there's all these levers you can pull and push to get to something like this. All right, so any questions on how stabilization impacts it? We didn't go into how we stabilized, but any questions on sort of the start and the end of where we are? No? Okay. So what I think we could do next, Jake, is maybe if we want, we can use the same asset, but I can go through a detailed underwriting and we won't really cover terms too much, right? Because I think if we can get a good understanding of the relationships, then we can move a lot faster on, the actual underwriting.
Yeah, let's do it.
Yeah. And like I mentioned earlier, if anybody has any questions or comments or thoughts, feel free. You can find me on Facebook Messenger. You can scan my QR code, and more than happy to set up some time to discuss with you any questions you might have.
I don't know about anybody else, but I learned a ton here. It was something we didn't get to cover on our call last week. So this is super helpful.
Oh yeah,
Yeah,
pages on pages of notes, man. I appreciate it.
Good, no worries. We can also even try a deal someone's looking at, in the next session, if that's something of interest to people. What I'll say is for people who are trying to learn how to underwrite, underwriting bad deals is still good practice. So don't feel like you have to wait for like something good to pop up on your thing, because if you're going to underwrite a good deal and you've never underwritten before, you won't even know it's a good deal. So you want to be able to. I'll tell you guys a story. When I first learned, I learned underwriting from a major operator's master underwriter, right? So I learned straight from, someone else is doing this for all of their assets under management. And what I learned was they were deals that I was underwriting when I was 2 or 3 weeks into it, and I didn't know I was pretty good at it. And I couldn't find any deals, and it was frustrating me. I'm like, none of these deals work. These brokers are crazy. And as I got better, I looked back at what I did. I'm like, those brokers are crazy. I wasn't wrong, right? I was doing it right. I just didn't understand enough to say, oh, like it makes sense. So you get better at understanding bad deals before you can find good deals, right? So
I don't like second position deals. We get a ton of second position deals come through, and
yes,
yeah,
yes,
on a small
definitely.
scale.
Yes. All right, great. So any questions, like I said, feel free to send me a note. I can stick my email here as well, but like I said, feel free to set up some time with me, and I'm more than happy to walk through anything with you guys. And then Jake will set up another time if you like for like a level 2 or 3 session.
Yeah, absolutely. Absolutely, for sure.
Great. I hope this is useful to everybody. Enjoy the rest of your evening, and look forward to giving you guys more insight next time.
Appreciate all you guys. Thank you.
That's great. Thanks, Steve.
All right. Thank you.
Absolutely. Thank you guys. Thank you.
Have a great night.
Thank
Yeah.
you.